Quick recap of what we are doing in the last class. We started with the topic derivatives. The fundamental factor for derivative is a price risk. We said what is meant by a price risk? The risk or the possibility that the price could undergo a fluctuation. Derivative contract refers to any contract which derives its value from one underlying asset. That's what we said. What is the purpose of derivative contract? Is to cover the price risk. Hedging. The underlying assets could be shares, forex, or anything. There are three types of derivative contracts: forwards, futures, and options. What is the difference between forwards, futures, and options? Forward and future, like there are two parties to the contract, and both the parties have got obligations. Options, like there are two parties to the contract. One party has got an option, another party has got an obligation. That's what we said. What is the difference between forward and future? Forward is a private contract between two parties. Future is a standardized contract which is traded in the stock market. In a forward contract, there is a buyer of forward, there is a seller of forward, there is an underlying asset, there is an excise period or the expiry date, there is an excise price. The risk in the forward contract is that there is a risk of default and it is illiquid. You can't transfer it to any other person. And to overcome this, we have something called as a future contract. Future contract is monitored by the stock market. There are quantity lots. You have to buy it in 500 shares or in 1000 multiples. You have to buy it in lots. And there is an expiry date, excise date, which is fixed by the stock market. I told you that last Thursday of every month is going to be the expiry date. The moment we say that I want to buy March 2018 futures, March 2018, last Thursday. That's what it means. All the futures expire on the same day. It's liquid, it can be transferred, there is no risk of default. The clearinghouse will collect the margin. In this context, we discuss something called as an initial margin and mark-to-market margin. What is initial margin? The moment you enter into a contract, of the total value of the contract, a percentage has to be deposited with the stock market. That's called as an initial margin. What is called as mark-to-market margin? Every day when the share price or the future price increases or decreases, based on which the investor has to ascertain whether he has to pay something extra or take back the deposit that he has already made. That's mark-to-market margin. That's what happens. Future contracts are settled through actual delivery or it is settled through squaring of the position. Squaring of the position could mean that for a buy contract, you take an alternative position, sell contract. Vice versa. For a sell future, you take a buy future. In miscellaneous, we discussed the law of convergence. We said that the spot price and the future price will be different. Spot price refers to today's price of the share and future price refers to the today's expectation of the excise date's price. As the spot rate increases and decreases, future rate will also increase and decrease. But the gap between the spot and future will start sharpening, and on the excise date you will find that the spot price is going to be the futures price. That's the law of convergence. Futures can be used for hedging or it can be used for money making, speculation also. I think we discussed this question in the last class. We'll solve it now. Question 8. On 14th July 2014, Amuda entered into the following transactions: purchased 5 lots of 2014 August Wipro futures at 534 per unit, sold 2 lots of 2014 July Wipro futures at 527 per unit. If the lot size is 500 units, determine the balance in MTM at the end of trading day from 14th to 18th if the following quotes are available. Cash market na spot price. Spot price is available. July futures, August futures. All these are available. 14, 15, 16, 17, 18. Let's take August futures. 2014 August futures. Now, purchased one lot size is how much? One lot is how many units? 500 units. Purchased 5 lots, it's like buying 500 shares. 500 into 5. 2500 futures. What is the excise price? 534. What is the expiry date? August 2014. So, see, understand, step number 1, it's 5 into 500 into 534, correct? This is the total value of the contract value. 13,35,000, you will have to pay a particular percentage to the stock market at first. That's called as an initial margin. This question doesn't want you to calculate initial margin. It wants you to calculate after that. What will be the incremental number that will happen? That's the question, right? MTM, mark to market margin. On 14th July, the time when you're entering into contract, let's say it's 11 o'clock afternoon. 11 o'clock when you're entering into contract, the price was 534 at which you entered into a contract. 14th July closing rate, 2014 August future. On 14th July, it closed at how much? 541. Investor stands to gain or lose. How do you understand 541? No. How do you understand 541? Today's expectation of August price. So I believe that August price will go up to 541. That's how the market is trading now. I bought it for 534, which means I have already blocked the price of that share. And then I can buy it for, enforce this contract and then buy it for 534, correct? The investor stands to gain here. How much he gains? 7 rupees. What minus what? 541 minus 534. So it's 7 into 5 lots into 500 shares that the investor will get back from this deposit. That's what will happen. So let's work out. Case A. The investor has bought 5 lots. 5 into 500. 2,500 shares. At an excise price of rupees 534 per unit. This theoretically means that in the month of August, the investor has to pay 534 rupees and take one share. In stock market, it doesn't happen. Normally, you don't, in the future, you don't pay money and then get the share. Rather, it's netted off based on that day's rate, exchange rate. Calculation of mark to market margin. Date, closing rate, cumulative profit, receive or pay. We will say gain or loss. So date 14th July 2014, closing rate is 541, cumulative profit is 541 minus 534 into 5 into 500, correct? 17,500 is a gain. Investor will receive. Right? Investor will receive. Next, 15th July 2014. Fifteenth July, what is the rate? 545. Tell me, what is the total gain he has made in the last 2 days? You'll say that it is 545 minus 534, correct? That's the total gain. He entered into a contract for his excise price will always remain the same, irrespective of whatever happens in the market. He has made a total gain of 27,500. 27,500, what he got already? 17,500. So what he has to get on the second day? It's 10,000. 10,000 is nothing but 541 minus 545, that 4 rupees extra. 4 rupees extra into 5 into 500. Gain. July 16th, 2014. 16th July, what is the rate? 539. 539. 539. Now, what is the total money he has made in the last 3 days? It's 539 minus 534, correct? Which is 12,500. This is the total profit he has made in the last 3 days, correct? And what is the money that he has already received for? 27,500, which is this number actually. It is this 27,500 which he has received. So what? You will receive money or pay money? Pay how much? 15,000. 27,500 minus 12,500. July 17th, 2014. What is the rate? 17th? 542. 542. So the total profit he has made in the last 4 days is 20,000. 20,000, what is the net money that he has received in the last 3 days? It's 12,500. So what will happen? He will receive 7,500. 18. Closing rate is 547. So that's how much total? 32,500. 32, what is already received? All these four numbers, which is nothing but 20,000. So what has to be received now is 12,500. Case B. July 2014 futures. 5 lots, 500 shares per lot. Exercise price 527. Future sell. 2 lots, I'm sorry. 2 lots. Right. Exercise price is 527. So he entered into the contract at 527. 14th July, what is the closing rate? 527. So there is nothing. 15th July. 15th July, what is the closing rate? 531. 531. Is that a gain to the investor or loss to the investor? Why? It's a sale. He agreed to sell at what price? 527. But what is the expectation of the market price? 531. See, you can also visualize it like on 15th July, the expected market price is 531. He has agreed to sell for 527. What does it mean? It means that he has to buy at 531 and he has to honor the contract. He only has a future sell. To do that future sell, he needs a share. And for that share, he need to buy it. And now that's being expected at 531. So he will end up paying 4 rupees extra. Okay. So it is 531 minus 527 into 2 into 500 minus 4,000. It's a loss. Investor cannot sell for 527, 541, 31. Investor cannot sell for 531. 16th, 529. 529. 529. Now what is the scenario? Cumulatively for 2 days, if I consider, there is a loss or there is a gain? Loss. How much? 2000. So I have to pay 2000. What already I have paid 4000. So what will happen on the second day? Investor will receive or pay? He will receive 2000, correct? So my agreed price is 527. Today's market price is 529, which means 2 rupees effectively I have lost. That's what I have to pay to the stock market. Already I have paid 4000. So 2000 will be refunded back to me. This will be refunded to the investor. It is a loss, but it is a reduction in loss, cumulative loss. 17th. 17th, what is the price? 530. 530. What is that? What is the cumulative position? Loss of 3000. What has happened in the last 2 days cumulative? 2000 has been paid. This is the cumulative position, right? So which means what should the investor do? Pay or receive? Pay how much? 1000. Eighteenth. 18th closing rate is 531. So investor will pay or receive? Pay 1000. Right? See, investor will not pay, you understand. He makes an initial margin deposit, no? Otherwise it will be reduced. All these numbers will be reduced. The more loss he makes, the initial margin gets eroded. It's only the margin which will increase or which will decrease. That's what happens. That's the real profit for the investor. This completes the question. Now up to this, what we have discussed is basics in derivatives. Then moving on further into futures, forwards and futures. Now comes valuation. How do you value a future? Now we say that futures are traded today at 531, or it's traded today at 527 when we say some values. How is it arrived at? That's what will be the next question. That's the valuation of derivatives. Transaction flow in futures. Transaction flow in futures. Point A. At time 0, enter into futures contract, pay initial margin. Enter into futures contract, pay initial margin. At time 0 to time E, MTM payment or receipt. So first step, you pay initial margin. Second step, every day margin gets accumulated or you get back your margins. Time E, refund of initial margin plus settlement of contract. This is how the cash flow will really happen in a futures contract. That's why the entire future trading is called as a margin trading. We trade only in margins. We keep a 10 lakh margin and then we trade for 50 lakhs. 50 lakhs plus or minus whatever you get, that gets adjusted in this 10 lakhs. Refund of initial margin plus settlement of a contract. Evaluation of futures price. Valuation of futures price. Now I want you to recollect the CAPM here. what we actually do in a CAPM, we understand what should be the price of a share, theoretical price, and what is the actual price, and then we decide whether it is underpriced or overpriced, whether it's fairly priced or not, and then we decide whether to invest or not. Same logic is applicable for futures. We have a theoretical valuation method with which we value what should be the future price of that share. And then we actually go to the stock market and then see today what is the future price of the share, at what price the futures are being traded. Remember, whenever I say future price, I don't mean the price on some other day. I mean today's price, today's future. September 2017 future as on today. That's what I'm referring to. As on today, what is the future? Future is a document. As on today, what is the value of this document? As per me, as per market. And then decide whether this is underpriced or overpriced. And you know the fundamental rule. When something is underpriced, you will buy. When something is overpriced, you will sell, correct? Same concept is applicable for a future also. When something is underpriced, you will buy futures. When something is overpriced, you will sell futures. For that, you need two things. What is the fair value? What is the actual value? Actual value is that which is traded in the stock market. Now, what is the fair value? If I say that there is Ashok Leyland share. Ashok Leyland share today it is quoted at, let's say, 300 rupees per share. 2 months from now, what could be the price of the share? I have to estimate. And then I'll have to keep it in my hand and then go to today's stock market and then see what 2 months future is quoted at. Then I will decide whether the stock market is underpricing or overpricing this future. How do I calculate the future price of Ashok Leyland? We again use only the discounting factor. We say that I don't know whatever be the future price 2 months from now, but that discounted to the present value should be the spot price. Discounting factor being RF. That's the basic model that we use. So what's going to be the future price 3 months from now, 4 months from now? Take the spot price of the share, which is traded in the stock market, compound it at RF, and then see what's going to be the price or the number that you get at a 3 months compounding. And that number is going to be today's future estimate. A company has to grow minimum at the rate of RF. If that doesn't happen, then what will be the scenario? We'll discuss that later. Then arbitrage will open up. That consequence will take it up later. But we are going to link the spot price and future price only with reference to RF. We say that the gap between them or future price is nothing but spot price compounded at RF. Spot price is nothing but future price discounted at RF. This is the theoretical valuation. And with this valuation, we go and see today into the stock market, what is the price at which futures are traded. And then we decide whether it is underpriced or overpriced. Meaning, future price of any security equal to spot price of the security compounded to future. Future price of any security, spot price of the security compounded to future. Spot price equal to present value of future price discounted. Future price equal to future value of spot price compounded. Discount rate RF. Discount rate RF. Now understand this example. If I say that I am investing 1000, which is compounded at 10%, which is the RF, let's say for example, and then the tenure is 1 year. So what will be the future value? It's 1000 into 1 plus 10% the whole power 1, 1100. If I say that this is compounded annually, if I say that it's half yearly compounded, then future value is going to be 1000 into 1 plus 5% over 2. Interest rate will be halved and then the tenure will be doubled. Correct? That's what we said. So which is going to be 1000 into 1.05 square. Correct? If I say it's going to be quarterly compounded, then this is going to be 2.5 and this is going to be 4. If I say it's monthly compounded, it's 1 plus the whole power 12. And there can be daily compounding also. Every second it compounds, then we have something called as continuous compounding, which is determined by E factor. And it is this continuous compounding which we'll be using now. When we say that the future value is going to be spot price compounded at RFN. Is it annually compounding, half yearly, quarterly compounding? No. Daily, every minute, every second. Continuous compounding. If there is a continuous compounding that's going to happen, we can't do this. Instead, we have a formula, E formula. We have a log table. Based on the log table, we find out what is the future value if there is an every second compounding that happens. Right? This is called as a continuous compounding. Concept of continuous compounding. Compounding or discounting will be continuous. Hence, E factor is used. Compounding or discounting will be continuous. Hence, E factor is used. Compounding factor is E power RT, where R is RF and T is time in years. E power RT. So if you say today it is 1000 rupees and you are investing for let's say 1 year and then the rate of interest is 10%, what we do is 1000 into E power R being 0.1 into T being 12 by 12, 1 year. And then we say what is going to be the future value. If you are investing for 6 months, at the end of the 6th month, what is going to be the future value? Now, 1000 into E power R is 0.1 into T is 6 by 12. 6 months, time in years. And then we find out what is the future value. Discounting factor is 1 by compounding factor. So it's 1 by E power RT. Decision rule. Theoretical future price equal to future value of the spot price. Theoretical future price equal to future value of the spot price. So we find out two things. We find out the theoretical future price. We find out the actual future price. Actual future price, let's trade at today at that rate. And then we decide. Actual future price equal to that which is quoted in the market. Traded price. Actual future price equal to that which is quoted in the market. Traded price. See the simple decision, the theoretical future price which we calculate and the price at which the stock is being traded now. Now means today's future as it is being traded in the stock market. These two things should be the same. If any one is higher, It means there is a pricing inefficiency. The market is not properly pricing that document. It's either overpriced or it is underpriced. Whenever it is overpriced, you will sell the future. Whenever it is underpriced, you will buy the future. As per your calculation, it's going to be 530 future price. But actually it's traded now for 525. It's underpriced. So buy it. So as per your calculation, 530, it's traded for 550. Sell futures. If actual future price traded is greater than theoretical future price, it means it's overpriced. When something is overpriced, what will you do? Sell. Sell futures. Within brackets, buy at spot. If actual future price traded is less than theoretical future price, it's underpriced. Buy futures, sell spot. That which is within brackets, I'll explain it to you later. It looks very simple to get the concept. Like sell future na buy spot, buy future na sell spot. But then there is a very big theory behind this. When you up to this, it's fine. When AFP is greater than the theoretical future price, it's overpriced. So sell future. That's logical. What is this buy at spot? Why would someone do this? What will go wrong if I don't buy at spot? What's the problem if I do only sell futures? All these concepts we'll discuss later. But understand this general rule. Whatever position that you take in a future market, you take a reverse position in the spot market. If you take a sell position in the future, you will take a buy position in the spot. Why? We'll discuss it. As we solve problem, we'll discuss it. Question 1. Question 1. Shares of Pranav Limited are being quoted at 500. Shares of Pranav Limited are being quoted. This is a spot price, correct? Today's price 500. 3 months future contract rate is 520 per share for a lot size of 500 shares, correct? So what is the exercise price? 520. What is the exercise period? 3 months. And what is the lot size? If the Pranav Limited is expected, I'm sorry, if Pranav, strike that word expected. If Pranav Limited is not expected to distribute any dividend in the interim, RF rate is 9%. What is the recommended course of action for a trader in shares? What should the investor do? RF is 9%. The company is not expected to declare any dividend for the next 3 months. That's the whole story. This is case 1. Case 2. If 3 months future contract today is 500, what should the investor do? Case 1 on the future contract is 520 per share, correct? That's what we'll try to solve. What should the investor do? So when the question asks you like this, the examiner wants to test you, are they priced properly? And then decide. What is future price? 520. And you need to calculate the theoretical future price, correct? How do you calculate theoretical future price? Future value of the spot, which is nothing but future value, just listen, is nothing but spot into e power RT, correct? That's the future value, compounded. Spot how much? 500 into e power R is 9%. Into T is time. How many months? 3 by 12, correct? Which is 0.0225. Correct? So if I have e power 0.0225 value, I can substitute this and I can find out what is the theoretical future price, right? I want you to pick the table somewhere at the end of this chapter. Page number 11, page number 10. Page number 10, you have it right. Continuous discounting and continuous compounding. Point not 1, point not 2, point not 3 it's there. E power minus x, e power rt. The first column is 1 by e power rt. You understand that? 0.02, what is the value? 0.02, it's 1.0202. 0.03, what is the value? 1.0305, correct? Now you need to find out what is 0.0225, linear interpolation. Same story will be there. 0225. This linear interpolation will be there until your last chapter. We'll do this in E, we do this in natural log, we do this in everywhere we do this, right? So we need to find out this value. I'm telling you roughly, if it's going to be, let's say 1.03, and then I'll say, I'll substitute this number here, and then I'll find out what is the theoretical price, correct? 515. And what is the traded price? 520. What's your comment? Your theoretical valuation says the futures are worth 515, whereas now it is being traded for 525. So 520 rather. So what's your conclusion? It's overpriced. When something is overpriced, what will you do? Sell. Sell futures. And when you sell futures, what is the reverse position you have to take? Buy at spot. What is that buying at spot? I'll explain it to you. But you have to take these two positions, right? This is case 1. Case 2, the futures are traded at 500. Your valuation says it's 515, but they are being now traded at 500. What do you understand? The futures are underpriced in the market. When something is underpriced, what will you do? Buy it. You buy future. So sell spot. That's the reverse position that you will take. That's how you complete the problem. By doing this, what really happens? I'll explain it to you later when we solve it towards the end. First, we'll value the theoretical price. Spot price. Spot price is how much? 800. Why we compound the value? The basic assumption here, every company has to give a return which is minimum equivalent to RF. If a risk-free investment gives me 9% return, Pranav Limited should also give me 9% return. Even if you remember in CAPM, that's what we start with, RF plus, then beta into all the other stories. So at RF, the shares has to grow. If today the share price is 500, RF is 10%. 1 year from now, share price has to touch 550. So we compound it. Future tenure is 3 months. RF is how much? 9%. Yes, yeah. Traded price of futures is 520. Theoretical future price equal to spot price into e power RT. Spot price on the 500 into e power R is 0.09 into E is 3 by 12. E power 0.03 is how much? 030. So what is the number that you get? 1.02. Any other decimals? 0 023. Any other answers? Please check. Point not 2. 0.03. 0.0225. 1.0228, correct? We'll take it up to 4 decimals. 1.0228. So 1.0228. So substitute the number here. So what is the theoretical future price that you get? Sorry, you get 511.4. No, 511.4 represents what? Today's expectation of the third month end price based on today's spot price. Always remember, when we are doing a compounding and discounting, the fundamentals of the capital budgeting will remain. It means the reinvestment can happen at this rate, right? So we conclude actual future price is 520 is greater than theoretical future price. Hence the futures are overpriced in the stock market. So when something is overpriced, what will you do? Sell futures and buy at spot. Sorry? Huh. No, we don't expect a loss-making company. We don't project a future price for a loss-making company. Whenever we say into E power RT, we only say that company will grow in terms of their net worth at the rate of RF. You can do it. But the intention here is not to evaluate the spot price, whether spot is accurately measured or not. What is a driving factor and what is a derivative? Spot is the driving factor, and derivative is what it derives its value from the spot. Based on if the market rate increases today, that will also increase. That's what we say. So we understand the spot is properly priced, and then we check whether the derivative is properly priced or whether there is any price gap in that. Theoretically, your approach will give you the same result. But the point here is, we go what is the dependent factor and what is an independent factor. We evaluate the dependent factor. Sell futures and buy spot. Now, I'll take you through an example. Just listen. What is meant by the term arbitrage? Arbitrage means whenever there is a pricing inefficiency. When you say that there is a product, what I told you in the last class, there is a product, book, that's available here, that's also available in the next street at different prices. Then what will happen? One can buy from a place where it is cheap and then sell at a price where it is costly. And he can make money without taking any effort. Arbitrage basically means you make profit without any risk. Is it possible for someone to make profit without taking any risk? It is possible, provided he identifies a pricing inefficiency in the stock market. When there is a pricing, for example, same share, Ashok Leyland share, in Bombay Stock Exchange it is 500, in Mumbai Stock Exchange it is 510. I'll buy from here and sell there. I don't take any risk. Right? So I need not hold it for a long time. Today itself it's priced at different rates, at different stock markets. Without taking any risk, even holding for one day, I buy it and sell it immediately. So this is called as an arbitrage profit that someone will make. Whenever there is an arbitrage, what will happen? Everyone will understand this and people will start buying from one stock exchange and they'll start selling in another stock exchange. Buy from BSC for 500 and sell in NSE for 510. Everyone will start doing it. When everyone starts doing it, the demand becomes so high in the Bombay stock market that the share price will increase from 500. Supply becomes more high in National Stock Exchange. Share price 510 will start reducing. And they average out at 505, which is the fair price in both the stock markets. So arbitrage will open up whenever there is a pricing inefficiency. Investors will pour in to cover that arbitrage and that will also be set off over a period of time. That's the whole idea. So here, when you talk about sell futures, look at this example. If you don't do this, you just sell futures. Sell futures at what price? 520. That's the traded price. 520. I mean, if I take a contract and if I keep quiet, then what will happen at the end of third month? At the end of third month, see, our theoretical calculation is 511.40, but it may happen, may not happen. Really, the share price today from 500, it can go to 520, it can go above 520, it can go below 520. Tell me, if the share price on this date goes to 525, whether the investor will gain or lose. What I am talking here is a future spot price. On that day, what's going to be the spot? If the future spot price is 525, and as an investor, I have taken a sell futures 520, they gain or lose? Lose. Why? I have to buy on that day at 525 and honor this contract to sell. Other way of thinking, I can't sell for 525. I'm stuck with 520. Even if I have already a share in my hand, I need not buy on that day. Still, I can't sell it for 525. I have to honor this contract, so I have to deliver it to that guy for 520. So anyway, I make an opportunity loss. 5. On that day, if the future spot price is 515, I make a gain. I can sell it for 520. Since the actual future price is greater than theoretical future price, and you have taken a decision to sell futures, don't think that you are risk free. Still, you are facing a risk. You only identified a prospective opportunity. You thought that the price will touch only 511, but it can really be more than 511 or 520, more or less than 520. So to cover up this, what you do here, buy spot. Look at this, what will happen. It means there are 4 contracts that you are entering. There is a sell futures and there is a buy spot. You sell future at an exercise price of how much? 520. For that you buy spot at a spot price of how much? 500. That's the spot price. Today the share price is 500, correct? Where do you have money to buy this? Borrow at RF. So let there be a borrowing. How much you have to borrow? 500 or 520? 500. You need to borrow 500. That's what will be funding us. If you borrow at 500, step one today from a bank or from a government, and then you buy a share at 500, immediately enter into sell futures for 520 today itself, and keep all the three documents put together closed for 3 months. At the end of the third month, you see what will happen. The borrowing will grow at the rate of RF. This will become 511.4 at a continuous compounding rate. You will have one share in hand. On that day, the future sale price will be 520. You may have to sell the future, correct? So you should have share for that. You will give the share and then you will get back a cash of 520. With this, you will offset this 511 and then you will make a profit of 8.6. Now tell me, at the end of the third month, if really the share price is 535, how your profit will be affected? Think and tell me, at the end of the third month, you have one share in hand and you have one contract to honor, and really the future spot price on that day is 535. Tell me what will happen. Your loan will still be 511.4. Still you will have one share in hand and still you will have one contract to honor. You will have to honor the contract for which you have to give the share, and then you will get the cash of 520. On that day, if the future spot price is just 510, still you will get 520. And whatever be the share price on that day, don't worry, you will make your money. That's what is called as an arbitrage. In an arbitrage, I enter into 3 transactions today, tie them up, and then keep it aside. Forget about the price fluctuation that's going to happen for the next 3 months. I make 8.6. Am I facing a risk in my borrowing? Will the borrowing rate undergo any change? No, it's a RF borrowing. It will never undergo a change in this chapter. Will my share price undergo any change? Will my future price undergo any change? Everything will change, but it will not impact me, correct? Because I have an agreed contract to sell it for 520, and for that I have a backed up by share also. I make zero risk on my borrowing. I make zero risk on my investment. I still manage to make 8.6. That's called as an arbitrage profit. That's why you don't stop with sell futures to buy a spot. All your study material, practice manual, everything stops here. But behind this, there is one more transaction: borrow at RF. Borrow at RF, buy at spot, sell the future, tie up these 3 transactions together, and then you have made your portfolio risk free. Liability will not change, asset will not change, automatically you will get your money. Let's make a note of this. Arbitrage profit. Step 1. Borrow at RF, rupees 500 at 9% rate of interest. Step 2. Invest in spot share today. Pay that 500. Step 3. Enter into sell futures at an exercise price of what is the exercise price? What is the exercise price of futures here? 520. All the 3 transactions above would form arbitrage investment. At the end of third month, use the spot share to use the share in hand to settle the future sell contract, receive 520 in cash. Borrowing would have grown to 511.40. This has to be paid. Net cash to the investor equal to 520 minus 511.40, 8.6. Short sell at RF. That's what will happen. You don't borrow at RF, you short sell at RF. That will be the next contract. You can further build on. If you want to short sell, you will short sell for the duration of the RF. So you immunize it. You understand? RF is subject to market rate fluctuations. So if you want to immunize it, you will have to invest it on the duration of RF. All these things will follow. This is the arbitrage profit. The investor does not take any risk on borrowings since it's borrowed at RF. He does not take any risk on investment since irrespective of the future spot price, the investor will earn 520. Hence, without risk, the profits 8.60 per share. No, what is the arbitrage profit per share here? It's 8.6. 8.6 is what minus what? 520 minus 511.6. What is 520 and what is 511? 520 is the excise price. 511 is the theoretical forward price or theoretical future price. In all the problems that we are going to solve, we'll not be writing all the stories. We'll only say arbitrage profit is equivalent to actual price minus theoretical price. That's it. Arbitrage profit equal to actual future price or forward price minus theoretical future price. Even for your exams, it's enough if you write this. The question wants you to calculate arbitrage profit, calculate the theoretical price, calculate the actual price, and then say arbitrage profit equal to A minus B. That's enough. All these are understood. Now we'll do case B. Case B, if future price is traded at how much? 500. Theoretical future price equal to, it's what we already calculated, correct? 511.40. Actual future price equal to 500. Now wait for a minute. Just listen. Just listen. Theoretical price is 511.40. That's what we calculated. How did we calculate 511.40? Spot into e power RT. What is spot price? 500 into e power. What is R? 9%. T is 3 by 12. We did that and then we found out 511. Actual price here is 500.500. So what is your conclusion? Futures are underpriced or overpriced? Underpriced. When something is underpriced, what is the next step? Just listen. Buy futures. What is the next step? Sell spot. Buy futures and sell spot. Correct? So you make, since there is a pricing inefficiency, there is an arbitrage gain that opens up. And what will be the arbitrage gain? Equal to AFP minus TFP. Correct? 11.4. That's going to be the profit. The difference between these two things is the arbitrage gain. How can we explain this? You do a buy futures, correct? And then you sell spot. You sell spot, which means you sell a share. Sell one share now, correct? When you are going to sell one share now, how much money you will realize? 500 you will realize. Get cash 500. That you will invest in RF. That you will invest in RF. This 500. Plus immediately buy futures. Do all the 3 transactions now. Tie it and then wait for 3 months. At the end of the 3rd month, what will happen? You will not have a share because it's already sold, correct? And you will have a cash, which is nothing but 500 compounded. That's going to be 511.40. This investment would have grown to 511.40, correct? And you have a buy futures to honor. And what is the price at which you have to buy futures? What is the price at which you have to buy futures? 500. That's today's traded price at which you have entered into the contract. So on that particular day, you will pay 500, correct? And then buy one share and give it back to your portfolio. You take one share on time 0, sell that share for 500, get cash, invest that, let it grow to 511.4, and then use that cash to buy another share for 500 and give it back to your portfolio. Short selling. When we discussed about short selling, I told you that how can you sell without having a share? We borrow and sell, correct? Automated lending and borrowing mechanism, ALBM. I give you an example. Same story is applicable here. This presupposes that you borrow the share. You borrow the share from stock exchange and then today itself sell it. And with that money you invest it and then immediately take a buy future for 500. That's the traded price. On the exercise date you will have 511 and with that money you buy the share and pay it back to the person from whom you borrowed the share. Of course, for that commission has to be paid. That's not a part of this discussion. But anyway, you will make a profit of 11.4. Your investment minus the payment that you have to make to buy a share on that date and give it back to the person from whom you have borrowed. 11.4. Again, it's TFP minus AFP. That's what will happen. The real fun is this is irrespective of whatever be the future price or spot price on that day. Whatever be the share price on that day, still you will make this money. So let's conclude this. Conclusion. Future prices. Future is underpriced. Decision. Buy future and sell spot. Now, behind the word sell spot, there are 3 transactions. You have to sell the spot. For that, you need a share. For that, you borrow. And if you sell the spot, whatever cash that you have got, you have to invest in RF. All these 3 will happen together. Borrow shares and sell it in spot. Get cash. What is the spot rate? 500. Invest in RF, rupees 500 now at 9%. Also take a buy future at an EP of exercise price today is, what is the traded price of future? 500, correct? This is the traded price. If you do all the three transactions together at the end of third month, what are all the things that will happen? Investment will grow to rupees 511.4 and cash it. Exercise the future contract, pay rupees 500 and get one share and buy one share. Return it back to share lending scheme. Net profit made, excess cash on that day, 511.40 minus 500, rupees 11.4. Arbitrage gain. In this problem, we'll solve like this more in detail. In all the other problems, we'll solve it in one single line. We'll say arbitrage profits AFP minus TFP. The difference is the profit. What you have to recollect is all the stories. Correct. Investor makes 11.4 gain here. No, after returning. See, as far as the stock lending scheme is concerned, it's okay. You put it this way: they give you a share, and you have to return back that share. 3 months later, you buy that share and then give it back to them. That's what happens. You buy that share at 500, you pay 500, buy that share and return back to them, piece to piece. That's it. As far as your cash is concerned, you make 11.4 excess. That's your gain. This is one way of visualization. Going one step further, there is nothing called as lending shares. No one will lend shares. This ALBM, automated lending and borrowing mechanism, is applicable only for certain brokers and some investors, high net worth investors, mutual funds kind of people. Stock market will allow them to sell even without having that share. That will be permitted. That's it. So theoretically, when you are visualizing, it's as good as you borrowing, selling, again buying it back and giving it back. But what happens is only the net. Stock market will permit me to sell the share immediately without having that share. It will give me 1 month time. There is a rollover concept. Sometimes rollovers permitted, rollovers not permitted. At the end of the first month, if I cannot manage to buy the share and give it back to the stock market, what the exchange will do is they will find out at the end of the first month what is the closing rate of that share. Stock market will assume as if you are buying at that rate and giving it to me, and they will reduce it from my margin. That's it. All these are only netting off. That's what will happen. But for our ease of understanding, we can always visualize that we borrow and then we sell. 3 months later, again we'll buy it back and give it back to the stock exchange. But everything happens electronically. Only the net of effect will be there.